Okay, folks, Dan Frio here, and it is Monday. I hope you guys had a fantastic Easter. We're going to start doing this, and we're going to try to do it sub 10 minutes because I lose a lot of viewers if I go past 10 minutes. So, my name is Dan Frio. I do the rate update every day. I'm here to inform you guys everything real estate, but I also talk about the markets. I talk about the bond markets, the real estate market, the stock market, the cryptocurrencies, everything of that. And if you want to ask me questions live, please join me every day at 3 o'clock Central Standard Time. You can ask these questions. So what you're seeing on your screen is basically the screens I see. Why? Well, I'm in the mortgage business, so I need to know what's going on in the bond market. So we have right here the 10-year Treasury. So that's a Treasury bond. And then we have the MBSs. This is the mortgage bonds. So if you really want to pay attention, if you're in the mortgage business, you got to know what the MBS is doing, okay? You don't want to pay attention to the 10-year Treasury because it's really not the gauge you want to follow. You want to follow the MBSs. So that's my tip of the day there. So let's get over to the economic calendar for this week that should be kind of market movers. Let's go through that real quick. So we got on Mondays, there's nothing really ever coming out on Mondays. Tuesday, we have the short-term energy outlook. We're going to bypass that because energy is so volatile right now. Coming to the juicy part of this. The inflation numbers. Now, you know how everybody in the news and everybody's telling us, what is it? What's in the news right now? Inflation, banking crisis, and jobs. Okay, that's the biggest thing here. Now they're talking recession. So let's get over back to this. This is why we need to focus in on this stuff. Right now, we see the inflation numbers. What the inflation numbers here is the CPI. Well, the CPI is consumer inflation. How much inflation are we getting? Okay, and then you have down here on Thursday, the PPI, producer price index, the inflation at the producer level. Why we focus on that? Well, if producers' prices are going up because of their raw materials and everything else, their inflation numbers, well, the only way that they can keep their same profit margins is by passing that higher cost on to us, the consumer. So the consumer prices are going to go up. So consumer inflation is going to go up. And we're going to monitor that this week. So on Wednesday, we have the CPI numbers coming out. You're going to see here, it says core CPI, CPI year over year, CPI month over month. What that is CPI is basically a basket of goods and services that the government monitors, and they monitor either year over year or month over month. Okay, so they take this basket and they say, okay, here's a basket of these goods. We put a price tag on it. Okay, what did it do the next month? Did the prices go up or down? That's what this reflects. Okay, so let's break these three down. Core CPI, basically, in that basket, they're going to strip out food and energy. Why? Because it's so volatile. Okay, gas prices are going like this. Okay, so it's a really hard gauge. So they pull that out and they want a more of a detailed consumer inflation index on just a specific group of goods. The next one you're going to see is CPI YOY. That's year over year. So March of last year to March of this year. How much did those prices change? And then you have here month over MOM, month over month. So where we were last month compared to this month. And then on Thursday, we have the initial jobless claims. Again, jobs, and inflation, okay, on the producer side of the equation. Here's what I want to discuss right now is the jobs report. Now, the jobs report came out on Friday and everybody's like, oh, it was robust. The Federal Reserve is going to increase rates again because that number was a little bit hot. Well, I'm going to be a little bit of a disagreeer of that. So if you go back to the charts from 1950 on, here's the trajectory of where jobs are. And this is the average. So if you walk through this line, you're going to see up through here, we aren't even at where we should be if we follow this basically 80-year chart. Okay, there's a shortfall there. We lost tons of jobs during the pandemic, which we all know. And then they came back, but they haven't come back. We're basically back to where we were pre-pandemic. So that doesn't mean there's a huge job market. We're not even where we should be if we just hold up the averages throughout the last 80 years. Okay, so, and if you really break down the jobs numbers, the sectors in there, the government employed a lot more people than was expected the previous reading. So that skewed the numbers a little bit. So that's my basically information on the jobs numbers. So please, dive into a lot of these numbers. Don't just take the headlines for what they're worth. Then inflation, we're going to talk about that this week. When the inflation numbers come back, I'm going to show you a couple gauges there where I think the markets and the Fed's missing the boat on some of these things. And last week I talked about a few different areas that they were missing on. So the next piece of the puzzle we want to go over is what the expectations are now from the Fed. Okay, so the market on Friday said, okay, the employment numbers were a little robust or more robust than we were thinking. So that might cause the Federal Reserve to raise rates. Well, they might be right because that's what some numbers are indicating right now. So right now, the federal funds rate, that's the rate that the Federal Reserve controls, is 4.83. All right. If you go over to where the expectations were, now this is the Chicago Mercantile Exchange. This is where big traders, hedge funds groups, everything out there, the big money is putting their money on where where the federal funds rate's going to go. What changed after Friday? Okay, so what happened is the Friday's numbers now indicate the Federal Reserve is going to raise rates again. So we have in the May meeting, there's a 70% chance now that the Federal Reserve is going to raise their rates another 0.25%. And if they don't do it then, they will be doing it in June, because you have, look at this, the odds of that happening between the May and June meeting. Then from there, look at what happens. None of these numbers are really changed that month. Then they're expecting a recession, and they're expecting the Federal Reserve to start pivoting and reducing rates. Okay, so guys, this is the Chicago Mercantile Exchange. This isn't me guessing. This isn't me just hypothetically saying things. This is where the money is going right now on Wall Street. So based on all this, what in the world's going on with mortgage rates? Because that might be why you're here. Here it is. It's taking a crash right now. You saw that go from minus 16 to minus 27. So we're probably going to see about an eighth of an increase in rates today. So let me explain to you guys what's going on right here. This chart right here, this is what the MBS market. This is the mortgage-backed security that trades on Wall Street. What you're seeing on here is the price of that bond, okay? When the price goes down like this, what happens is there's an inverse or a flip-flop effect to the rates. So if the price of the bond goes down, rates are going to go up. Okay, a decrease in price of 0.27 is probably going to equate to an increase in rates of about 0.08. It might teeter to 0.1 increase in rates, but let's get over to see where we are right now. So this is the top 6 products that people use when they're buying or refinancing a home. These are rates published by Mortgage News Daily. Now, Mortgage News Daily isn't a lender. They're not a bank. They're just, they survey banks all over the country. So they send out a survey to all these banks and said, if you had a borrower looking to buy a house, putting 20% down, 740 credit score, single family home, their first home, what would the rate be? These are the averages, folks. So there's going to be rates that are much higher than this. There's going to be rates that are probably much lower than this. These are the averages. These are not my rates. These are not any individual bank's rates. So you're seeing them right here from the 30-year fixed all the way down to the 30-year VA loans. So that is my report for today. Hopefully I did it under 10 minutes so you guys can get informed with the Real Estate Minute from Dan Frio. That might be my new name for that. So it's not called that. But if you guys like the context that I provide and you want to interact with me every day, just join me at 3 o'clock Central Standard Time, where I answer all the questions you have in regards to the stock market, the bond market, cryptocurrencies, real estates, or anything else you guys want to ask, because I think the schools are failing us, guys. So I take it upon myself to educate you guys out there when it comes to the financial markets. God bless, guys. Thanks so much for watching. I'll see you later. Bye-bye.